Hi, I'm Jeff Colton. This week we're looking at the cash flow statement. It helps explain the changes that have occurred in the cash balance over the course of a financial period. Information about cash generation and management is a particularly important part of running a business. A cash flow statement is useful in providing users with a basis to assess the ability to generate cash and the needs of the business to use cash flows. A statement of cash flows, when used in conjunction with the rest of the financial statements, provides information that helps enable users to evaluate the changes in net assets of an entity, its financial structure, including its liquidity and solvency, and its ability to affect the amounts and timing of cash flows in order to adapt to changing circumstances and opportunities. It enables users to develop models to assess and compare the present value of future cash flows of different entities, an important part of valuation. It also enhances the comparability of the reporting of operating performance by different businesses because it eliminates the effects of using different accounting treatments for the same transactions and events. Historical cash flow information is often used as an indicator of the amount, timing, and certainty of future cash flows. It is also useful in checking the accuracy of past assessment of future cash flows and in examining the relationship between profitability and cash flow. It's probably worth noting at this time that cash, for the purposes of the cash flow statement and the cash account on the balance sheet, typically means cash plus cash equivalents. Cash is cash on hand plus your bank deposits, while cash equivalents are short-term, highly liquid investments that are readily convertible to cash and which are subject to an insignificant risk of changes in value. This is things like short-term government bonds or commercial notes or paper with a maturity of less than 90 days. So, the statement of cash flows shows the sources and the uses of cash during the period. The cash flow statement is divided up into three sections: cash flows from operating activity, cash flows from investing activities, and cash flows from financing activities. Operating activities are based on the day-to-day revenue-producing activities of the entity. They include things like receipts from selling goods or providing services, as well as payments to suppliers, payments to employees, insurance, rent, tax, and so on. The separate disclosure of cash flows arising from investing activities is important because those cash flows can help us determine the extent to which expenditures have been made on resources intended to generate future cash flows and income. Only expenditures that result in an asset being recognised on the balance sheet are eligible for classification as investing cash flows. Examples include cash payments for property, plant and equipment, intangibles and other long-term assets. It would also include cash receipts from the sale of property, plant and equipment, intangibles and other long-term assets, as well as cash payments to acquire equity or debt instruments of other firms. Disclosing cash flows from financing activities is important because this is useful in predicting claims on future cash flow by providers of capital to a business. Examples include cash proceeds from issuing shares or other equity instruments, cash payments to owners to acquire shares, and cash proceeds from issuing debt instruments or borrowings, and the cash repayments of the amounts borrowed. Interest and dividends received and paid need to be separately disclosed. Annoyingly, they can be classified as operating, investing, or financing, as long as firms are consistent with their classification. Cash flows from income tax are classified as operating unless they can be specifically identified with financing or investing activities. Cash from operations can be reported using the direct or the indirect method, with the Australian accounting standards encouraging the direct method. It shows the receipts and the payments arising from cash flows from different classes of providers. The cash flow statement will give you information on how well your firm is generating cash in its day-to-day operations, the extent to which it's investing in growth, and the extent to which it can meet its financial obligations. The relative levers of operating, investing, and financing cash flows will vary over a firm's life cycle. Indeed, many ratios will vary systematically with firm life cycle. That is, whether a firm is young and growing, mature and stable, or declining. Analysing the cash flow statement can let you address a variety of questions regarding the dynamics of a firm's cash flows. This includes: how strong is the internal cash flow generation? Is cash from operations positive or negative? If negative, why? Does the firm have the ability to meet its short-term financial obligations, such as interest payments from its operating cash flows? How much did the firm invest in growth? Are these investments consistent with the firm's stated business strategy? And did the company pay dividends from its internal free cash flow, or did it have to rely on external financing to do so? What type of external financing does the firm rely on? Equity, short-term debt, or long-term debt? And is the financing consistent with the firm's overall business risk? In summary, the statement of cash flows provides a measure of managerial performance in managing cash. So smart managers must be aware of how their efforts are reflected in it, in the same way as they are aware of the measures of economic performance and financial position found in the income statement and the balance sheet.